All right, hi everyone. Welcome to today's webinar brought to you by IC Markets, where we'll be looking at moving average analysis. I just want to make sure everyone can hear me loud and clear and see my presentation slides as well, which should be the front page, right? IC Markets Global Webinar, Moving Average Analysis, 30th January. All right, let's just wait for about a minute before we get things going. All right, all right, and the Q&A windows and the chat box are open as well, so do not hesitate to drop your questions along the way. Right? Should you have any queries or any questions about any particular point, do not hesitate to drop your questions in the Q&A box. All right. All right. I think we're good to go. Right. All right. Welcome everyone. Welcome everyone to today's webinar brought to you by IC Markets Global. Today's webinar is going to be on the topic of moving average analysis, and let's just get things moving. All right. Okay, so just want to, could I just have a quick confirmation by anyone in the webinar to make sure that audio is loud and clear? You can see my slides as well. Right, I'm just going through the disclaimer now. Right, okay, so please take note that this is marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in the financial instruments. Also take note of the risk warning that comes with trading Forex and CFDs. They carry a high level of risk to your capital and you should only trade with money you can afford to lose. All right, thanks Samir, thanks for the acknowledgement. All right, so my name is Ketan Ramachandras and I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IC Global Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so here's the agenda for today. So we're just going to start off with the basics first. What is a moving average or MA? Just quickly go through the two main kinds of moving averages and how they are calculated and how can they be potentially be used. Then we'll look at how to use the SMA and EMA to identify trends. So SMA is basically a simple moving average and EMA is an exponential moving average, which we will cover in the first part. And then we'll use the SMA and EMA to identify crossovers as well. So we'll go through some of the various combinations that we can use to identify the crossovers and how can they be applicable in our trading strategy. And then we'll dive over into TradingView and look at the current price action and try to apply some of those crossovers and trend identifying techniques. All right. Okay, so what is a moving average or MA? Well, basically, it is an indicator commonly used in technical analysis, right? It's probably one of the first few indicators that most beginner traders use. And not only beginner traders, established traders continue to use them as well. Right, so the moving average or MA helps to smooth out the price data over a specified period, right? So this period can be 10-day, 20-day, 50-day, 100 and 200, right? These are the more common periods that are used. And by smoothing the data over a specified period and by creating a constantly updated average price. So when we use a moving average, as the name implies, it averages out the price data over a fixed period of time or a specified period of time. And that average or window is always moving. That's why it's called a moving average. Okay, so there are two main kinds of moving averages. We have a simple moving average and an exponential moving average. So the simple moving average is simply commonly known as SMA, while the exponential moving average is otherwise known as EMA. Right, so the SMA, as the name implies, is a simple moving average. It just takes a simple arithmetic mean or arithmetic average of a given set of prices over a specific number of days in the past. Right, so if you take a 10-day moving average, what it does is it just takes the closing price of those last 10 candles and sums it up and averages it out by 10, right? And then it's a moving average, so that's how they do it. And for the exponential average, it's a weighted average, right? That gives greater importance to the more recent price data. So that means if you have a 10-day moving average, it will take, for example, maybe the most recent data. So let's say the most recent 3 candles. It'll give more importance to those recent 3 or 4 candles while giving less importance to the earlier candles, right? So that means that the exponential moving average is more sensitive to the recent price action, and that means that indicator would move or react more quickly than a simple moving average. And so we can see this in the charts later as we go through it coming up, right, as we go through the slides here. All right, so how can we use a moving average? Well, they're typically used to identify the trend direction of any particular instrument, right? It doesn't matter whether you're trading the indices, the commodities, currency pairs, the majors, crosses, or any other instrument, right? They can be used for any asset class, and it can basically use to identify the trend direction of the instrument and also to determine its support and resistance levels. Now, do take note, this is a trend following indicator because it is based on past prices, and also it is a lagging indicator, right? So generally we will see price reaction, of course, react first, followed by the moving averages with a lag. All right, hi Mustafa. Please define EMA, SMA. All right, okay. We'll just go through that again. All right. So SMA is a simple moving average, right? It just takes the arithmetic mean or the average of a given set of prices over a specific number of days. That means there's no weightage given to each of the data sets or data points. Whereas an exponential moving average is a weighted average. So what this means is the candles that are more recent, this will be given a higher weightage versus the later candles. So that means the moving average itself or the indicator itself is going to react more quickly to the recent price changes. All right, so in essence, just to sum it up, EMA reacts quicker than the SMA, right? Just to put it in plain English, right? These are the official definitions, but to put it in plain English, the EMA basically is an indicator that's going to react faster to recent price changes rather than the SMA. So this is what we'll see in the charts as we over the next few slides. All right, okay. What did I say? All right, welcome Mustafa. All right, okay, so it's a trend following indicator, and because it is based on past prices, it is also a lagging indicator, right? So we are obviously going to see price action react first, then we will see this indicator move accordingly, right? So if price suddenly reverses strongly and bounces higher, the indicators, the SMA and EMAs are going to take time, and eventually we will see them turning up and moving higher as well. Similarly, when prices have a bearish reaction and fall sharply, it'll take a while for the moving indicators to follow suit as well, right? Okay, and in a general case, the longer the period for the moving average, the greater the lag. That means, for example, if you're using the 200-day moving average on your charts, it's going to react much more slower than, for example, the 20-day moving average. So usually, of course, the lower periods or shorter periods, 10 and 20, will be reacting faster than the longer periods such as the 50, 100, and 200. Right, 50 and 200 days moving averages are widely used by investors and traders. They're considered to be important trading signals. The crossovers, not only the crossovers, but the moving averages themselves help to identify major support levels and resistance levels, and the crossover points also help to determine or give confirmation of a reversal, right? So when the 50-day crosses above the 200-day, that's typically known as a golden cross crossover. And then when the 50-day moving average moves under the 200-day moving average, that's typically known as the death cross, right? Okay, and the other common lengths are 10, 20, and 100. Okay, of course, these are just words and text. We'll go through the charts later where it's easier to visualize what has been presented here so far. All right, okay. Now we're going to use some examples of the charts. We're going to use the simple moving average and exponential moving averages to identify trends. We'll use 3 instruments to do this. We'll use the US 500. Okay, so that tracks the S&P 500 futures contract. So it's basically the benchmark as a US equity index. Then we'll use the dollar index as well, right? The dollar index helps us to identify the value of the US dollar versus its peers, and then we'll look at a currency pair as well, which is the euro dollar. Hi Ashfaq, I'm getting to that, right? This is just the start of this is just the slide. I haven't gotten to the next part yet. So here's the slide, right? Okay, so in this chart, I'm using the US 500. I'm on the daily time frame, and in here I've set up my simple moving averages. So I've got the 10, 20, 50, 100, and 200. So 10 is in light blue, 20 is in purple, 50 is in orange, 100 is in turquoise, and 200 is somewhat in I guess pink color here. So as you can see, the moving when price is in the uptrend, as we saw in April of 2023 all the way to August of 2023, right? This is the US 500. When price is rising higher left to right, we can see when it's a general bullish trend, price will be trading. I can only see the first screen, not any plot. Hang on, okay, just let me make sure. Oh, all right, wait, apologies. Wait. Okay, were you guys able to see all this as well? Sorry, apologies. Were you guys able to see? All right, I think there must have been okay, the screen must have gone on to, oops, apologies for that. I think the screen went to, yes, okay, apologies for that. Let me just start over again quickly. For some reason, I think the presenter screen got switched over. All right, okay. So just all right, okay, so welcome to today's webinar brought to you by IC Markets Global, right? We'll be covering moving average analysis, right? Do take note of the disclaimer here, right? And also of the risk warning that comes with trading Forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. All right, apologies for that, guys. I thought the presenter screen was directed at the slides, but that was not the case. So let's just quickly go through this. All right, so my name is Ketan Ramachandra. So I'm your host for today. And this is the agenda, right? Okay, so the agenda, we are going to cover what is a moving average, then using it to identify trends, crossovers, and we'll look at some live examples as well. All right, apologies for that. Okay, so here's just the slides. This is what I just mentioned earlier. So I'll just keep the slides. I'll just quickly run through this. I won't repeat this again, right? So do not hesitate to take a screenshot of this at any point, right? You can take a screenshot of the slides as you go along. So do not take that. So main thing is here, what's the difference between an SMA and EMA, and what is the technical definitions of a moving average. Okay, and then what is the moving average? What is it used for? Basically, it's a trend identifying indicator. It can also be used to determine support and resistance levels. Do take note, it is a lagging indicator, so we're going to see price action obviously react first before the indicator catches up. Right, the typical periods that we use for moving averages are 10, 20, 50, 100, and 200. And the death cross and golden crosses are defined by the 50 and the 200 day. The crossover between the 50 and 200 day moving averages are typically identified as the golden cross and death cross, which I'll explain with a chart below as well. All right, okay. Right, okay, I guess everyone can clearly see this chart now. I'm on the US 500. I'm using the instrument for the US 500. This instrument tracks the S&P 500 futures contract. So here I'm on the daily time frame. So as we can see, I've got all the moving averages set up here: 10, 20, 50, 100, and 20. The 10-day moving average is in blue, 20 in purple, 50 in orange, 100 in turquoise, and 200 in pink. So as you can see, since April till August of 2023, the US 500 was in a pretty strong bullish trend, and we can see that price was trading above all the moving averages in general, right? So when we see price trading above the moving averages, especially when it's trading above the 10 and 20 moving averages here, as we see the blue line and purple line, typically this indicates a bullish trend. Conversely, when price drops underneath the 10 and 20-day moving average, this typically would identify a bearish trend, as you can see here, right? So in August till or for pretty much the whole month of August, the price had moved under the 10 and 20-day moving averages to indicate a bearish trend. Similarly, when price goes above it here, you can see so you can generally see how we can use the 10 and 20-day moving averages to help us identify the trend. So do take note, I am on the daily time frame. So this helps us to establish the longer term trends. So once you're able to establish the longer term trend, then we can scale down into the lower time frames, for example, the H4, H1 or 30-minute time frames, and then apply our strategy accordingly, right? So I'm going to use the examples on the daily time frame so that we can learn how to use the moving averages to help us identify whether this is a bullish trend, bearish trend. And then once the main trend is established, then of course we can zoom in into the lower time frames and fine tune the analysis, right? So in general, as we can see here, because the 10 and 20-day moving averages use a shorter period, they react quicker to the price action, whereas when we see the 50, the 100 and 200, they take a longer time to react, right? Basically the 200 and 50 and 100, they don't react at all in the sense that you can see they're still rising upwards, right? But it's only the 10 and 20 that react much more quicker to the change in direction as well, right? So when price is going up, they are also moving up. Then when price reverses to drop lower, the 10 and 20 moving averages also reverse quite quickly to drop lower as well. So as a general rule, using the 10 and 20-day moving averages help us to quickly identify the current trend and also the reversals as well. So as you can see, the crossovers here, the 10 crossing over the 20, going down, signaling a potential, rather because it is a lagging indicator. When the 10 crosses over the 20, it is sort of giving a confirmation that the bullish trend has reversed and price has started to fall. But as you can see, price action clearly precedes the crossover and price has already started to fall. So what we are using the crossovers for would be to give us a confirmation. Similarly, in this case here, when price crosses over the 10-day moving average, crosses over 20-day moving average, it gives confirmation that the trend has reversed, but price has of course reacted much earlier. And even here as well, when you have the 10-day moving average crossing over the 20-day moving average again, this gives confirmation that the bearish trend here, the previous bearish trend, has reversed and price is going higher. And we can use the 10 and 20-day moving averages to help us define or identify levels of support. As you can see here, price is sort of like surfing the 10-day moving average, right? Price finds support on the 10-day moving average or surfing the 10-day moving average and is constantly going higher. And at this point here, early 2024, and as a few days ago as well, last week, price found support at the 20-day moving average, and once again here before bouncing higher. So the 10 and 20-day moving averages can help us to identify support levels as well. So if we have identified this to be a bullish trend, but we are waiting for price to pull back before perhaps entering a long position, you can wait, for example, for it to pull back towards the 10 or 20-day moving average before going long on that position again, right? So this is for the US 500. I also have charts that will show us the crossover, so we'll get to that in a bit. All right, so next chart I have is for the dollar index, where the dollar index helps us to give a value of the strength of the US dollar relative to its peers. So similarly, here we can see that the 10 and 20-day moving averages, which are in blue and purple, react much more quickly to the changes in price action, whereas the 50, 100, and 200 take a much longer time to actually react, right? So when we are doing, when we have perhaps what I'm trying to show here is, I guess if your strategy involves intraday trading, right? Probably it's just better to use the 10 and 20-day moving average on the daily time frame to establish a longer term trend, and then you can move down over to the lower time frame. Probably using the 50, 100, and 200 may not be so relevant when we are strategies that involve intraday trading. Okay, so this is for dollar index. So similarly, when you see the crossover take place here, for example, in August of 2023, right, the 10-day moving average crossing over the 20-day moving average, it sort of gives us confirmation that this previous bearish trend has reversed and goes higher. But do take note, you can have false signals as well, right? So when we look here in July, we did see the 10-day moving average cross over the 20-day moving average, but there was no follow through in the trend. So do take note, the crossover points can also generate or yield false signals as well. So do take note of that. Not every crossover is certain to give a confirmation. There can be false signals as well. So please do take note of that. All right. Okay. The next chart I have is also on the daily time frame. This is the Euro USD. So similarly, we can see how when the 10-day moving averages crosses over the 20 and price is trading underneath it, we can see quite clearly this is a strong bearish trend. So when you see price action such as this and price trading underneath the 10 and 20-day moving average in this scenario, right, we can establish that the trend is bearish, and we should be looking to identify any retracements to the high side as a potential sell entry point, right? So that's when you we do the analysis on the daily time frame to identify the longer term trend. Then you zoom in onto the lower time frames to identify resistance levels or potential pullback levels to help us identify potential sell entries. Similarly, when we have the crossover here, 10 crossing over the 20-day moving average, price itself is trading above both the 10-day and 20-day moving average. It gives us confirmation that the euro is trading in a bullish trend, so we should be looking for pullbacks to identify potential long entries, right? So once on the daily time frame, we can establish the longer term trend, or the overall trend rather. Then we zoom in into the lower time frames, H4, H1, 30 minutes, or whatever time frame that you're used to, and then to identify potential long entries, right? So you could be a scalper, you could be an intraday trader. Once you have identified the overall trend for that current period, then we can scale down or zoom down into the lower time frames and apply our strategy accordingly. All right, now we'll look at EMAs, or exponential moving averages. So one thing that I think we can quickly notice between the EMA and SMA, do take note, I'm still using the same periods, 10, 20, 50, 100, 200. The main thing that we can see is that the 50, 100 and 200 EMAs are reacting much more noticeably than the SMAs did, right? 10 and 20 is also naturally going to react much more quickly, but as a general sense, when you look at SMAs and EMAs, 10 and 20, generally we are not able to notice the difference quite obviously, right? But for the 50, 100 and 200 EMAs, they are noticeably different in price in movement, right? So if I quickly go back to the US 500 SMA, right? US 500 SMA, you can see that the lines are more spaced out, right? The 50 is spaced out further from the 20, 100 from the 50, 200, 100 from the 50, and 200 from the 50, right? But for the EMAs, we can see that the spacing is narrowed, is closer, and they react quicker to the changes in price action. So generally, you can use simple EMA and EMA, SMA and EMA, but because EMAs tend to react much more quickly to the recent price actions, I would prefer to use the EMAs, right? So similarly here, we can see price is rising when price is trading above the EMAs 10 and 20. Generally, it tells us that this is a bullish trend, and we can use the 10 and 20-day EMAs to help us identify support areas and potential long entries as well. So when we know the overall trend is up, we can use the 10 combination of 10 and 20 EMAs to help us identify support areas to identify potential entries for the long side. Right. Similarly, when price is trading underneath the 10 and 20s, we can also try and use them to help us identify potential short entries as well. Okay, now we'll just quickly go over to the DXY. So similarly, we can see 50, 100 and 200 reacting much more noticeably versus the SMAs, right? Same for Euro USD, we can see that as well. Okay, so this is quite similar to what we saw. So as a general note, well, personally, I prefer to use the EMAs because they react quicker, right? So, and do take note, 10 and 20 is probably more useful to use on the daily time frame to establish the overall trend, and then zoom in onto the lower time frames after that to fine tune the analysis. Okay, now we'll look at crossovers, right? SMA and EMA crossovers, and how can we use them, and why are they important? Okay, so over here, right, we can see, okay, let me get my pen. Right, okay, so once again, I'm on the daily time frame. The first chart I'll show the US 500. We're using the 10 and 20-day simple moving averages to identify the crossover points. So you can see there's one crossover point here. We also have another crossover point here and another one over here. Right, okay, so at point 1 is 10 moving above the 20s. When you see 10-day moving averages are moving above the 20, typically that gives confirmation of a potential bullish trend. Do take note, the crossover points, whether it's a bullish crossover or bearish crossover, can give false signals as well. So in this case, we did get a good confirmation call and price did rise up quite strongly. Similarly here at point 2, we see the 10-day moving average cross underneath the 20-day moving average, which sort of signals the reversal of this bullish trend. But you can see that price did pull back over a period of 4 days, but it was not an extended fall, right? The pullback wasn't extended. It actually found support at this previous support level before going higher. And then over here at point 3, we see the 10-day moving average crossing above the 20-day once again to give us a confirmation, or potential confirmation rather, that the bullish trend has now begun again. And from this part here, from June of 2023 till August of 2023, we can see that price was trading above the 10 and 20-day SMAs. The SMAs also were trending upwards. They were moving upward with price naturally. And you can see that the 20-day moving average offered support in July, as at the end of June rather, and in the middle of July as well, before price goes higher. So when we can see that this is indeed a longer term bullish trend, price can typically find support at the 10-day moving average or 20. In this case, in the end of June and middle of July of 2023, price found support at the 20-day moving averages both times before proceeding to go higher. Now, at point 4 here, we have a crossover taking happening as well. The 10-day moving underneath the 20-day moving average. And in this case, you can see that the downturn was an extended pullback, right? We can see that over a period of 2 weeks, right, about 2.5 weeks, price did move lower in a meaningful way, right? So in this case, at point 4, what we're seeing is a confirmation of the bearish trend, right? Naturally, we can see both times price action always leads the crossover. The crossover is delayed, right? That's why we say the moving indicators or the crossover points are provide a lagging indicator. They are lagging signal, and they can also be they can also generate false signals as well. So that's something important to take note of. So at point 5, right, we see another crossover, right? Once again, 10 crossing over the 20, price action obviously reacting first. But in this case, the move to the upside was not extended, right? Price stalled to drop lower. So in this case, we had a false signal here, a good signal here, good signal at point 1, good signal at point 3, point 2 was a bad signal as well. So you can see even on the daily time frame, right, where the data is somewhat less noisy, the moving averages can still present false signals, right? Then we have point 6 here, 10-day moving underneath the 20-day moving average, generating a positive signal. And in this case, you can see for another period of almost 2 weeks, or a bit more, price falling quite strongly. So in this scenario, we will be looking to identify potential short entries. Right now, it doesn't matter if you're a swing trader, daily trader, day trader, or intraday trader or scalper, once we know the general trend or the overall trend, it's much easier to apply our trading strategies, right? So here we get that. Then at point 7, we have 10-day crossing over the 20-day moving average, but generates false signal, right? But at point 8, we get a positive signal. And similarly here, as price is rising up, we can see that S&P 500 found support here at the 20-day moving average. This one not so good. It actually broke a little bit below here and here, but you can generally see how the 20-day moving average recently has acted as a pretty strong support level for price for the US 500. Now let's look at the dollar index. Similarly, we can see various crossover points, right? The first one that we see is here back in middle of May 2023.1, right? Crossover 1. This is a good one, right? Because we can see a very extended bullish move up here from about 101.50 to about 104. Similarly, at point 2, we see the crossover taking place. The 10-day moving average crossing underneath the 20-day moving average, giving us an extended downward move. So in this scenario, we should be looking to identify potential short entries as price retraces higher. Here, point 3, we get a false signal, right? We see 10-day crossing over the 20, but it's actually a false signal. Where we get a positive signal is at crossover number 4. 10-day moving average crossing over 20-day moving average, and price you can see is surfing the 10-day moving average here till September, then finding support on the 20-day moving average before bouncing higher. Then over this period here in October, November, price is surfing the 10-day moving average all the way till about 107 dot maybe about 40, right? Quite close to 107.50. Then we can see price running into major resistance here. You can also see price sort of consolidating roughly at the end of October, early November. Price for the dollar index was roughly consolidating between 105.50 and about 106.50 roughly before breaking lower. Then we can see the next crossover happen, which is crossover number 5. This generated a positive signal, right, to indicate with 10-day moving average crossing over the 20-day moving average, creating a positive signal. So this tells us that, okay, we are on the start of a bearish trend, and we should be looking to identify potential short entries as price is retracing. So in this case, price dropped quite strongly here at the beginning of November. It retraced higher for a period of 1, 2, 3, 4, 5 days. It did not go above the 20-day moving average. So in this case here, the 20-day moving average acted as a resistance area, right? And then price proceeded to drop lower, right? So this is how we can use the moving averages as well to help us identify support and resistance areas, right? In this case here, right, from August to November, the 10 and 20-day moving averages offered support or help us to identify areas of support. Then in November to December, the 10 and 20-day moving averages then proceeded to show us areas of resistance, right? Then here we had a crossover here, 10 crossing over the 20 at crossover number 6, but this yielded a negative result, right? This was a false result. Price proceeded to drop lower for the dollar index before finding support at about 100.50. And then at crossover 7, we got another confirmation for a potential bullish trend, which in this case turned out to be a positive signal, right? So 10-day move crossing over the 20-day, and you can see price is pretty much surfing the 10-day moving average to go higher. So the current trend in 2024 for the dollar index, right, is still to the upside for now, right? Prices based on just moving averages, right? The trend is still to the upside, is still a bullish trend. Price continues to surf the 10-day moving average and is bouncing higher. So do take note, this latest candle here is today's candle. This candle here is today's candle. Right, okay, then similarly on the euro, right, when the 10-day moving average is above the 20-day moving average, price is surfing the 10-day moving average, you can see that the euro is in a strong bullish trend. Right, the crossover probably happened over here, right? Crossover 10-day crossing over the 20-day moving average. This was crossover 1, yielded a positive result. Crossover number 2 also yielded a positive result, 10-day crossing underneath the 20-day moving average, and with price itself trading underneath it. And one thing to note is also when the 10-day moving averages starts to sort of bottom or plateau, right, and drop lower, that also can sort of indicate a potential reversal as well. But do take note that because the moving average itself is a lagging indicator, sometimes price has already reacted before that. So similarly, when we see the 10-day moving average sort of bottom here and start to turn upwards even before the crossover, sometimes it does help to identify a potential turning point or reversal point, right? So in this case, at point 3, we see another crossover, 10-day moving over the 20, gives us a positive signal, and euro dollar goes up high, going from about, what is this, 106.70 to as high as 109.50, right? So quite a strong move over a period of roughly 10 trading days or so. So similarly, in this instances, we'll be looking to identify potential long entries and to capitalize on the upward move. Over here, price pulls back quite sharply, initially it does find support on the 10-day moving average, but then it breaks underneath it, finds support for a period of 3 days on the 20-day moving average before breaking lower, and then when price crosses up again, we get another crossover, 10-day over the 20 and crossover number 4, giving another positive confirmation that of a bullish trend. Similarly, at crossover number 5, right, we see the 10 moving under the 20, price drops quite sharply, very sharply, I would say, and and you can see the 20-day moving average has sort of offered help us to identify a major resistance area as well, right? Of course, price has broken above the 10-day moving average several times, especially with the wicks you can see here. But the only time price really broke above the 20-day moving average was here in September of 2023. But then price proceeded to drop lower again. So we can see in this case how the 10 and 20-day moving averages help us to identify potential resistance areas. Similarly, here on the upside, the 10 and 20 moving average, especially here, and in this period, November to December, we can see how the 10 and 20-day moving averages help us to identify the support areas. Over here as well, in mid or end October, we get another crossover. This is crossover number 6. Right, crossover number 6 also yielded a positive signal, right? 10-day crossing over the 20, signaling a potential reversal in price, and it was the beginning of a very strong move up for the euro dollar as well, right? Going up from, if you look at exactly the crossover point at about 105.70 to as high as 1.100, right? Of course, price did pull back over here quite sharply after the crossover, but generally you can see that the crossover points do help us to identify the longer term trend or the overall trend most of the time, right? Not always, but most of the time. Here at point number 7, this is a pretty good, it's not the best crossover or the best signal, right? But because you can see price falling sharply before, of course, price will always react first, price falling quite sharply, then the crossover happens, but we do get a somewhat decent signal here, although it's really towards the tail end of the move, where the crossover signal comes literally at the tail end of the move. So it's not really practical, right? It wasn't really a practical signal. Whereas this crossover here and here at 0.5, 0.6, 0.4, offered a practical signal as well. Then we had the crossover at 0.8, right? This happened at the beginning of 2004, 10-day crossing over the crossing underneath the 20-day moving average, and also price continued to drop lower. And you can see how the 20-day moving average has offered an area of resistance as well so far. And clearly price is still trading underneath the 10 and 20-day moving average to indicate a strong bearish trend. So in a scenario like this, we should be looking to identify potential short entries for the euro dollar as well. All right, this is 20 and 50. Okay, so naturally, when we look at 10 and 20s, the crossovers, when we use the 10 and 20 moving averages, whether they're EMAs or SMAs, they naturally will occur much quicker, So I'm just going to quickly run through the 20 and 50 as well. So you can use just 20 and 50 as well, but you can see the crossovers are delayed, right? Price has already peaked over here in April of 2003, but the crossover occurs in sometime in May, right? So and over here as well, but this is point one, crossover one, crossover two. Similarly, price bottomed in June and was already sort of trending upwards, right? You can see a ascending trend line here, but the crossover actually happens in August. So naturally, we can see when we use longer periods of moving averages, the crossover points tend to be delayed, and especially if you're a intraday trader, scalper, this sort of crossovers are probably not useful, right? So I'm just going to just show you examples and quickly move through it, right? Even if you're a longer term investor, it's sort of like a very delayed signal, right? Sort of a very delayed signal because you can see the peak has already occurred over here. Similarly, the bullish crossover happens here, but price actually bottomed in October, right? Price bottomed in October, but the bullish crossover comes in, I would say, November, December, probably around there, right? I'm just showing you examples of how when how much of a lag there can be in the crossovers when we use longer periods of moving averages. All right. Okay, so let's just quickly go through this, right? It's going to be the same as well, especially for 50 and 200 as well. You can see like, okay, 50 and 200, this is typically known as a death cross, where they have the 15-day moving average crossing underneath the 200-day moving average. But of course, we can see price action had already preceded the death cross by easily three to 4 months. Right. Similarly here, we had the golden cross where the 50-day moving average crosses over the 200-day moving average, but actually price had already bottomed at the end of October, and we got the signal only in January or February. So you can see that the death crosses, which is usually the 50 and 200-day crossover points, they are very, very delayed. Okay, this is similar for the dollar index and the euro as well. So as you can see, it is much more practical to use the 10 and 20-day EMAs or SMAs. They help us to identify the crossover points and the turning points much more quickly, and it's something that's more actionable for us as well, especially if we are intraday traders and scalpers. It's better to use the crossover points on the 10 and 20-day SMA or EMAs to help us identify the trends. All right, so let's move on over to the charts and trading view, because this is pretty much the same here, right? So you can see here we get the 10-day or 20 and 50. It's quite delayed. Price actually bottomed out in November. Similarly for the DXY as well, and for the euro. All right, I think let's just dive straight into the charts on trading view so we can try and do the analysis on the current price action. Oops, where did it go? Hang on. Right, okay. Okay, so let's look. Okay, is there any requests that I'd like to do the analysis on? Let's do something that something from the audience. What would you guys like me to use? Which instrument would you like me to use? The DXY, the euro, dollar, yen, or pound, and then we'll just use that and then do the analysis together. Otherwise, if there's no requests, then I'll use the dollar index. Is that fine? Right? I'll use the dollar index. All right. Okay. So I'll just use the EMAs, right? So I'm using the EMAs, 10-day EMA, which is the blue line, 20-day EMA, which is the purple line, and I'm on the daily time frame here. So, right, as you can see, the crossover point occurred here, which is on 16th of Jan, but price actually had a sort of bottom in 20th of December as well. So we can use moving averages with other indicators as well, right? Of course, you don't have to just use moving averages. We can use other indicators as well. We can use the stochastic indicator as well. So in this case, my stochastic indicator is set up with the parameters to be 20 for the length, 3 for percentage K and percentage D smoothing. Right, for those who may not be so familiar with stochastics, right? It is a stochastic oscillator. It helps us to identify potential overbought areas and oversold areas. So when the oscillator moves above 80, it typically signals a overbought position in price, and when the oscillator drops below 20, it typically signals oversold positions. Right, just as a quick summary. Right, okay, but when we're looking here, right, we can see here, whenever price has come up as high on the oscillator at about 97, it does show some overbought positions as well. So when it comes to the oscillator as well, when it drops down below 20, right, it does help us to identify potential long positions as well. So for example, here in July of 2023, the oscillator, stochastic oscillator dropped as low as 2.4, 1.4, then started to turn up. We can see price also bottom around here. Right, price bottom around this area before proceeding to go higher. So the stochastics in this case helped us to identify a potential bottom in price action, right? Stochastics falling as low as 1 or 0.96, then turning higher. The price also bouncing off this level. And then after that, we get the confirmation from the EMA, 10-day moving EMA, crossing over the 20-day moving EMA to give us a confirmation of the bullish trend. So we can see how we can use in this example the combination of the stochastics and the crossover to give us a good sense of reversal in this bearish trend, right? We can see price was trending lower since June, mid of June, right? But then the combination of stochastics and then followed by the crossover gives us a good sense of conviction that the bearish trend has indeed reversed and price is probably going to go higher, right? Similarly here, right, so similarly here as well, we see price finding a good decent support here on 28th of December. We also see stochastics dropping pretty low and then turning higher. And then after that, we get the confirmation here on 15th of Jan to tell us that this is the start of a strong bullish move to the upside, right? And also to the downside, when the crossover happens over here, 10-day moving average crossing underneath the 20-day moving average, right? We can also see stochastics starting to fall, and then we can see price trading underneath the 10 and 20-day moving averages, and of course with the moving averages pointing down as well, right? So just take note, when the moving averages are obviously naturally moving up, it indicates a strong bullish trend, right? As you can see here, May to June, August to October of 2023, and then towards the end of 2023, when the 10 and 20-day moving averages were moving down, you can see that this also indicates a very strong bearish momentum or bearish trend. Right, okay, so now that we've seen what it looks like on a daily time frame, let's just go over, for example, into the 1 hour time frame. Right, on the 1 hour time frame, it's also, when we use it together with the stochastics, it can also help us to identify potential long entries and short entries as well, right? So when we look here in 23rd of January, right, you can see the bullish crossover take place over here, and you can also see that stochastics bottomed out on 23rd of Jan, 7 a.m. GMT time, and then the crossover happened at about 11 a.m. GMT time on the same day to give us that confirmation. So going from here, by using the stochastics to tell us that this is very likely oversold, and then seeing the confirmation here on the 30-minute chart, and probably entering at about, let's say, 103.30. Obviously we cannot capture the perfect move, but let's just say hypothetically 103.30 to about 103.70, at least, you know, we can capture 40 pips on this intraday trade as well. Similarly here, when price stochastic has reached quite high to the threshold here of 97 and starts to turn lower, and we also see that in the 1, 2, 3 candles dropping lower, perhaps we can identify a short entry as well, and then price is falling lower, and then we get the confirmation over here, 10-day moving crossing over the 20, and as stochastic drops underneath the 20, you can probably target that area as a potential exit, and also you can use the previous support here, previous support level here as a potential take profit zone to the downside, right? So you can see how even once we have established the overall trend on the daily time frame, then of course we can zoom in into the 1 hour time frame or even the 30-minute time frame to establish or to help us identify long and short trading opportunities, right? And when you combine the moving averages with another indicator such as the stochastic oscillator, it can help us improve the probability of finding better long and short trading ideas as well, right? So this is what I'm trying to explain here today in today's webinar, right? So what we are seeing now here, right? So it's better to use the stochastic oscillator when it's at the extremes, right? Like for example, now where it's currently trading, where it's currently not trading, but where the oscillator currently lies, right? Over here, it's sort of like in the middle of nowhere, right? Nowhere. But when we know it's trading, when it's moved above the threshold of 80, right? When it's moved above the threshold of 80, and then suddenly we see price topping out, right? Price failing to break above 103.77 roughly and starting to drop. Then as well as stochastics then turning away from the upper limit, then this gives us an opportunity to go long, right? We can put our stop loss at a level that's just slightly above here. For example, in this scenario, your stop loss would be just to give us a little bit of allowance. Let's just say we give ourselves a 15 pip buffer, so you'll be putting it at 98, 103 to 98. You put your stop loss at 103.98, depending. In this case, I put a stop loss of 15 pips above this, the top of this wick, and let's just say hypothetically we entered at around here, right, at about 103.70, right? We entered about 103.70. We put our stop loss at about 104, right? So that's about a 30 pip stop loss, and then we have the sort of like the confirmation of the peak, because stochastic starts to turn lower, and then after that we get the confirmation here when the 10 crosses over the 20, right? And then when we see oscillator dropping as low as 8.5, right, then that's where we can potentially look to exit the position. So you would have exited the position here at about 103.40 roughly, and if you had entered about 103.70, that would have helped locked in at about 30 pip profit, which is not too bad for an intraday trade, right? So this is how we can use the combination of stochastic oscillator and moving averages to help us identify long and short entry trading opportunities, right? Now this of course can be used across any instruments, right? Like I said earlier, moving averages are not confined to any particular instrument or any particular time frame, right? You can use it across various time frames, various instruments. But generally for me personally, I just like to start on the daily time frame to establish the overall trend, right? Use a daily time frame to establish the overall trend, combine it with another indicator that you're familiar with and understand well. For example, it could be the stochastic oscillator, it could be anything else. And then after that, zoom in onto the lower time frames to try and identify, to fine tune the entries and exits, right? So even on the 30 minutes as well, right? You can sort of probably do it, but for me, you can still do it on a 30 minute. It's not as noisy. That's probably fine. But perhaps when you go into the 5 and 15, things can get a little bit noisy there. So personally, for me on intraday trades, I would use daily first, establish the longer term trend, then go down into the 4 and then 1 hour time frames to try and identify potential opportunities, right? So right now, one opportunity would have been here when stochastic starts to come up, right? Stochastics bottoming here at 1 a.m. GMT time today, and stochastics has to move up. We also see price action moving up. So hypothetically, we could have entered a bullish long position here at about 103.40. The crossover has yet to take place. 10-day moving average is still trading underneath the 20-day moving average. We don't have that confirmation yet, right? So as you can see, price has moved up quite as high as 10 pips. So in this case, right, to protect the position, initially your stop loss would be about, let's just say, 10 pips underneath this level. So it would have been underneath at about 103.25, right? And price is moving higher. But to protect the position as price is moving higher, we should trail the stop loss to at least bring it up to break even, so that if we do get a false signal and price continues to drop lower, at least we can exit the trade with minimal loss. All right. Right. Okay. So I've come towards the end of today's webinar. Right. I'll just quickly launch a poll. And also, if you have any questions, please do not hesitate to drop them in now. I can quickly try and answer them as well. So I'm just going to launch the poll. And should you have any questions with regards to today's webinar, please drop them in the Q&A box as well. All right, and before we wrap up, do take note, we've got quite a few economic data events coming up. We've got the FOMC meeting on 31st January, GMT time 7 p.m. The statement is released 31st January, 7 p.m. GMT time, followed by Chairman Jerome Powell's press conference at 7:30 p.m. GMT. We've also got the Bank of England releasing its monetary policy statement on 1st of February, Thursday, and we've got the highly anticipated non-farm payrolls coming up on Friday, 2nd of Feb. So we've got a lot of market moving data points coming out, which is definitely going to inject high volatility into markets. So do look out for these events, because we do not want to be unnecessarily be stopped out due to higher volatility over these periods. All right. All right, great. Thanks everyone for tuning in today. Just close the poll, and yeah, we'll just quickly go through the end disclaimer as well. All right, just quickly go through the end disclaimer. And oops, here we go. Sorry, yeah. So do take note of the risk warning that comes with trading Forex and CFDs, right? They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. All right, thank you everyone for tuning in today. Do look out for all upcoming webinars by IC Markets, and I wish you all the best in your trading journey, and I'll catch you all at the next webinar. All right, thank you everyone.